Look, back in 2018, Indian banks were basically staring down the barrel of an 11.6% bad loan crisis. I mean, it was a massive systemic threat.
Well, absolutely. Systemic is the right word.
Yeah, but today, that number is sitting at 2.6%. So how exactly did the Reserve Bank of India engineer, one of the most aggressive banking cleanups in modern history? And, well, more importantly for you listening right now, what are the exact regulatory numbers you need to memorize?
Right, because you are exactly 11 days away from the RBI DEPR Phase 1 exam.
11 days.
Exactly. And look, we know you've got that Delhi School of Economics master's background.
Yeah.
So your analytical rigor, that's a given.
Yeah, the macro theory is second nature at this point.
It is. But this DEPR Phase 1 exam demands a completely different cognitive muscle. It tests your absolute recall of the institutional plumbing, the hard numbers.
So that's the mission for this deep dive. We are doing an intensive, focused memory drill for the next 20 minutes. Every single metric, every timeline, every percentage we hit today is a highly probable test question.
Yet we want to hardwire these regulatory numbers into your short-term memory. When you see those multiple choice options on exam day, your reflexes just need to take over.
Let's start right at the foundation. Before a scheduled commercial bank can, lend a single rupee or move any money, they have to prove they have enough skin in the game.
Right. Enough internal shock absorbers to survive a crisis. Which brings us straight to the Basel III capital adequacy framework.
Which is all about how much of a bank's own money is actually at risk.
Exactly. So globally, the Basel III minimums mandate a common equity Tier 1 or CET1 ratio of 4.5%.
Okay, 4.5%.
Then Tier 1 capital overall has to be 6%.
Yeah.
And the total capital ratio, the CRAR, sits at 8%.
I always find it helpful to visualize this like a fortress wall. Right? It's protecting the depositors inside.
That's a great analogy, actually.
Yeah, so that CET1, the Common Equity Tier 1, that's your solid stone foundation. It's the absolute highest quality capital, paid-up equity, retained earnings. It's money the bank just owns, free and clear.
Right, no strings attached.
Then Tier 1 adds extra layers to that, like perpetual bonds, the additional Tier 1 or AT1 bonds. And finally, you have Tier 2.
Which is like the outer palisade.
Yeah, exactly. Subordinated debt, general provisions. It absorbs some impact, but it's not as structurally sound as that equity core.
But here is the crucial distinction for your DEPR exam. It's about how the RBI applies that standard domestically.
Because they don't just blindly follow Basel.
No, they don't. The Basel global minimum for CRAR, the capital to risk-weighted assets ratio, is 8%. But the Reserve Bank of India forces scheduled commercial banks to maintain a stricter 9%.
You need to lock that in. India at 9% RR versus Basel's 8%, that 1 percentage point matters in the exam.
It's guaranteed to show up. And the RBI does this because emerging markets just inherently face higher macroeconomic volatility.
Like inflation shocks.
Exactly. So they demand a thicker structural buffer. Yeah. And building on that, there's also the capital conservation buffer, the CCB.
Right, which is an extra 2.5%.
Yeah. Yes, 2.5% made entirely of that high-quality CET1 capital. So when you add that 2.5% to the global 8% base, the effective global minimum is 10.5%.
And India aligns with that 10.5% standard specifically for the big guys, right, the DSIBs.
Systemically important banks, yes, because if one of them fails, it triggers systemic contagion.
So a bank builds this 9% fortress plus the buffers basically to protect itself from bad loans, which brings us back to that wild stat from the intro.
The massive drop in NPAs.
Yeah, let's unpack the FY26 asset quality numbers, because the landscape here has completely shifted.
It really has. As of the FY26 data, the gross non-performing asset ratio, the GNPA for scheduled commercial banks, is roughly 2.6%.
Which is the lowest in over a decade.
By far. And the net NPA ratio is down to approximately 0.6%.
Now, with your DSE background, we don't need to baby you on what an NPA is. But for the exam, let's be crystal clear on the difference between gross and net here.
Sure. GNPA, the 2.6%, is just the raw percentage of total advances that have defaulted.
Right, the gross bad loans.
Yeah. To get the net NPA of 0.6%, you just net out the provisions the banks have set aside from their profits to specifically cover those losses.
Which brings up the PCR, the provisioning coverage ratio. Think of it like a shock absorber. How strong is India's PCR right now?
It's very strong. The exam metric you need is approximately 76%.
So 76 pays of every rupee of bad loan is already covered.
Precisely. The bank has already locked away that money to absorb the loss. And a rising PCR is your best indicator of improving bank health.
It means the balance sheets are clean and legacy losses are dealt with. But contrast that 2.6% GNPA with the 2018 peak.
Right, near 11.6%.
That's a massive drop. And it wasn't just magic or like organic economic growth. Banks were writing things off, but they were also using legal mechanisms to force recoveries.
Yeah, the government and the RBI brought in some heavy artillery, the biggest one being the Insolvency and Bankruptcy Code of 2016, the IBC.
What makes the IBC so different from all the old clunky recovery laws?
Strict statutory timeline. It's a time-bound corporate resolution process.
Which is the defining feature.
Absolutely. The moment a default happens, admission into the IBC process is mandated within 14 days. And then, the Committee of Creditors has to finalize a resolution plan strictly within 180 days.
Write that down. 180 days. That is the core exam metric. But wait, there is an extension, isn't there?
There is, but it's not a free-for-all. It can be extended to an absolute maximum of 330 days, and that requires explicit approval from the NCLT.
The National Company Law Tribunal.
Right, and if day 330 passes without a plan, the process just terminates and the company is automatically pushed into liquidation.
Wow. And what do banks actually get back through this?
Historically, the haircuts under IBC range from 40% to 60%, so creditors recover about 40 to 60 pays on the rupee.
Okay, but let me push back here. If I'm a bank and I'm looking at a 60% haircut plus a potential 330-day delay, why on earth would I use the IBC if I hold high-quality secured collateral?
You wouldn't?
I mean, if I have the physical deed to the factory, why wait a year?
That's exactly why the Sarfisi Act of 2002 exists.
Ah, okay. The Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act.
Try saying that 3 times fast. But yes, Sarfisi. It is specifically built to bypass those judicial bottlenecks. If your loan is fully backed by secured collateral, this act lets you seize and sell that asset without any court intervention.
Zero court involvement.
Zero. Which makes it incredibly fast.
So if there's a hierarchy for speed on the exam?
Sarfisi is undeniably the fastest for secured assets. If you can't use Sarfisi, you go to the debt recovery tribunals, the DRTs.
Which are specialized courts, right?
Yes, faster than normal courts, but they still have massive backlogs. So the speed hierarchy is Sarfisi first, then DRT, then civil courts at the absolute bottom.
Okay, so that's the defensive side, clawing back bad debt. But the RBI plays offense too. They literally direct where banks must lend their money to fuel development.
You're talking about priority sector lending, the PSL norm.
Exactly. What's the foundational rule here?
The 40% target. Scheduled commercial banks must lend 40% of their adjusted net bank credit, their A and B C, to priority sectors.
And the exam is definitely going to test the subtargets within that 40%.
Guaranteed. The biggest chunk is agriculture, which is mandated at 18% of A and B C. And within that, there are specific subtargets for small and marginal farmers.
So they can't just lend it all to massive corporate farms.
Exactly. The next big one is weaker sections, which has to hit 10% of A and B C.
What else is in the 40% umbrella?
You've got MSMEs, export credit, education, housing, social infrastructure, and renewable energy.
Okay, but think about this structurally. I get how a domestic bank does this. They have thousands of rural branches.
Wow.
But what about a foreign bank?
Right. One that only has like 5 branches in Mumbai or Delhi.
Yeah. Mandating them to hit an 18% agricultural target is physically impossible.
And the RBI knows that. So the rule is, foreign banks with 20 or more branches are treated exactly like domestic banks. Full 40% target, all sub-targets apply.
And if they have fewer than 20 branches?
Then they have lower, modified targets. The RBI adapts to their operational reality.
That makes sense. But even for domestic banks, what if you're a corporate-focused bank in Mumbai? Hitting 18% agriculture is tough, but a rural bank in Punjab might easily hit 25%.
Right, there's a mismatch.
How does the RBI solve that without just fining the Mumbai bank?
Through a market mechanism. Priority Sector Lending Certificates, or PSLCs.
Oh, this is like a cap-and-trade carbon credit market, but for banks.
That is exactly how it works. The Punjab bank that overachieved its target can sell a PSLC to the Mumbai bank that underachieved.
So the corporate bank just buys the regulatory credit.
Right. They pay a fee for compliance. But the actual credit risk of the loan stays entirely with the Punjab bank.
Got it.
They also have the co-lending model, where commercial banks partner with NBFCs to originate these priority loans together, sharing the risk and the regulatory benefits.
Nice. Okay, so we've covered capital, bad debt, and lending targets. Now let's talk about the actual plumbing, the infrastructure moving all this money around second by second.
The payment systems hierarchy.
Let's start from the top down.
At the very top, you have RTGS, real-time gross settlement.
This is for the big money.
Right, high-value interbank and corporate transfers. The defining number here is the minimum limit. Strictly 2 lakh rupees.
2 lakh minimum.
Yes. It settles in real time on a gross basis, meaning individually, not in batches. And in December 2020, it was extended to be available 24/7.
Okay, stop right there. Everyone listening, pay attention. This is a massive exam trap.
Oh, the NEFT trap.
Yes. If you are reading older textbooks or looking at past exam papers from a few years ago, you will see questions saying NFT operates in batch mode with cutoff times during banking hours.
That is completely outdated.
That is outdated. Any MCQ reflecting that old system is wrong. Do not fall for it.
Right, the RBI overhauled it. Since December 2019, NFT has been fully 24 hours a day, 7 days a week.
It does still use batches, though, right?
It does, but they're automated, half-hourly batches running continuously around the clock. And unlike RTGS, NEFT has no minimum and no maximum limit.
Okay, good. Keep going down the hierarchy.
Next is IMPS, the immediate payment service. It's instant, 24/7, but the key metric is the maximum limit of 5 lakh rupees per transaction for retail.
5 lakh max. And then finally, the big one, UPI.
The Unified Payments Interface. It's actually built on top of that IMPS infrastructure.
Which is why it's instant.
Exactly. The daily limit for a standard UPI transaction is 1 lakh rupees. But for verified merchant transactions like healthcare, education, or certain investments, it bumps up to 2 lakh rupees.
And it's cross-border now, too, isn't it?
Yes. UAE, Singapore, the UK, and they keep expanding.
Okay, so RTGS, NFT, MMPS, UPI, they all move traditional bank deposits. But the RBI is also piloting a totally new form of money that completely bypasses deposits.
The e-rupee, the central bank digital currency, or CBDC.
There are 2 tracks here, and you need to know the difference for the exam.
Right. First is the wholesale CBDC, the e-rupee wholesale. This launched in November 2022. It is strictly for interbank settlement of government securities.
So not for regular people?
No, strictly institutional. It's designed to reduce counterparty risk in massive security settlement.
And the second track.
Retail CBDC, the e-rupee retail, launched in December 2022. This is for the general public.
Okay, here's a conceptual question. If I hold retail e-rupee in a digital wallet on my phone, what interest rate do I get? Is it like a high-yield savings account?
No. You earn 0 interest.
Zero.
0. The RBI firmly clarifies this. Retail e-rupee acts exactly like digital cash. It's a bearer instrument. If you have a physical 500 rupee note in your pocket, it doesn't earn interest, right?
Right.
The e-rupee behaves identically. It also offers privacy much closer to physical cash than a bank deposit.
And just to be clear, it is not a cryptocurrency.
Absolutely not.
Yeah.
It is issued and fully backed by the RBI. It is legal tender.
All right. The concepts are on the table. You are 11 days out. It is time to drill the core numbers one last time. Absolute recall right now.
Let's do it. High energy rapid fire. I'll fill the topic. You give the metric.
Ready?
Capital to risk-weighted assets ratio, CRAR.
India 9% versus Basel 8%.
Asset quality.
GNPA 2.6%, net NPA 0.6%, and PCR 76%.
IBC resolution timeline.
Strictly 180 days, max 330 days with NCLT approval.
Priority sector lending target.
40% of adjusted net bank credit.
RTGS minimum.
2 lakh rupees.
IMPF maximum.
5 lakh rupees.
UPI limits.
1 lakh regular, 2 lakh verified.
And MIT operational hours.
24/7 since December 2019. Do not fall for the batch timing trap.
Perfect. If you can rattle those off like that, you are in incredible shape.
You already have the DSE analytical rigor. Now you have the RBI institutional memory locked in. Trust your preparation.
And as you head into these last 11 days, I want to leave you with one final thought to ponder.
Lay it on us.
We just talked about how systems like UPI process massive volumes instantly, and how CBDCs are introducing digital fiat.
The velocity of money is insane right now.
Exactly. It's moving at the speed of light. So if a systemic shock happens today, the liquidity drain would be exponentially faster than in 2008. The question is, eventually, how will the RBI need to adjust those static Basel III capital buffers, or the PSL norms, to handle the sheer speed of a real-time digital bank run?
Wow. That is a phenomenal question. Probably not for your phase 1 multiple choice, but keep that in your back pocket for the essays or the interview stage.
Absolutely.
All right. Trust your repetition, keep drilling those numbers, and good luck on the exam.